Market Digest script. Hey friends, welcome to the Singapore Market Digest for Tuesday, June 17th, 2025. I'm Iggy from the Investing Iguana, and today we're diving into what's been happening on the SGX, giving you the critical updates you need to stay on top of your game. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I've produced over 900 videos with more than 500,000 watch hours as of June 2025. I also focus on regional and global economic trends. Today's Market Digest brings us some fascinating developments from our local champions. We're seeing mixed signals across different sectors, with aviation showing steady progress, while our export numbers delivered quite a surprise. Let's break down what this means for your investment strategy. Starting with Singapore Airlines, ticker C6L, our national carrier continues to demonstrate why it's considered one of the world's premium airlines. The company and its budget arm Scoot reported a 3.1% year-on-year increase in passenger traffic from May 2025. While this growth has moderated from April's stronger performance, it still shows consistent recovery momentum in the aviation sector. What's particularly telling is the performance difference between the two brands. Singapore Airlines achieved a 3.5% increase in passenger traffic, while Scoot managed a more modest 1.4% growth. This divergence tells us something important about current travel patterns. Premium travelers are returning to the skies faster than budget-conscious passengers, which could signal either economic confidence among higher income segments or simply pent-up demand for quality travel experiences. The load factor numbers paint an even more encouraging picture. Singapore Airlines achieved an 85.2% passenger load factor, while Scoot hit an impressive 91.0%. These figures show that despite increasing capacity, both airlines are filling their planes efficiently. The group's overall passenger load factor improved to 86.4%, up 0.3 percentage points year on year. But here's where it gets really interesting for investors. The cargo operations are showing even stronger momentum than passenger services. Cargo loads climbed 4.2% year on year against just a 2.9% increase in capacity. This pushed the cargo load factor up to 57.2%, supported by what the company describes as front-loading activity amid growing uncertainty in global trade. This cargo strength provides a nice hedge against any potential volatility in passenger demand. Singapore Airlines shares closed 1% lower at 687 Singapore dollars before this news broke, which might present an opportunity for those who understand the underlying operational strength. The airline now serves 128 destinations across 36 countries, with Singapore Airlines covering 78 destinations and Scoot handling 72. This extensive network positions them well for continued recovery as global travel normalizes. Moving to the healthcare sector, Q&M Dental Group, ticker Q7, just completed a significant strategic move. The company's mandatory unconditional cash offer to acquire all remaining shares in its subsidiary Aoxin Q&M closed on Monday evening. At the offer's close, Q&M Dental now owns approximately 52.7% of all Aoxin shares, up from its previous 50.53% stake. The offer price of 0.0321 Singapore dollars per share represents the company's strategy to consolidate control over its operations. Q&M shares ended Monday 1.3% higher at 0.39 Singapore dollars, showing market approval for this consolidation move. This fits perfectly with Q&M's broader strategy of focusing on organic growth in Singapore's competitive dental market. The company has been investing heavily in technological initiatives, including new dental mobile applications and integration of advanced dental technologies. These investments position Q&M well in a market where differentiation through technology and service quality becomes increasingly important. Now here's where today's digest takes a more serious turn. Singapore's non-oil domestic exports just delivered a massive surprise that caught everyone off guard. The numbers fell 3.5% year on year in May, completely contradicting economist expectations of 7.8% growth. This represents a dramatic reversal from April's robust 12.4% jump. The monthly comparison is even more striking. On a seasonally adjusted basis, exports contracted a whopping 12%, completely erasing the previous month's 10.4% expansion. This volatility in our export numbers reflects the challenging global trade environment we're navigating. Electronics exports, which are crucial for Singapore's economy, managed just 1.7% growth. This represents a dramatic slowdown from April's impressive 23.4% surge. Meanwhile, non-electronic shipments actually contracted 5.3%, led by significant declines in petrochemicals, non-monetary gold, and specialized machinery. The geographic breakdown reveals even more concerning trends. Exports to the United States plunged 20.6%, while those to Thailand dropped 17%. Even our traditionally strong markets like Malaysia, China, the European Union, and Japan saw declines. This broad-based weakness suggests global demand challenges rather than issues specific to any single market. What makes this particularly noteworthy is the timing. These export figures come at a time when many analysts expected continued recovery momentum. The sharp reversal raises questions about the sustainability of global trade growth and Singapore's position in increasingly complex supply chains. For context, Singapore's economy relies heavily on trade, with total trade typically representing more than 3 times our GDP. When export numbers swing this dramatically, it sends ripples through our entire economic ecosystem. Companies across various sectors, from logistics to manufacturing support services, feel the impact. This export weakness also highlights why diversification remains so crucial for Singapore-focused investors. While our domestic service sectors like healthcare and aviation can provide some insulation, we can't completely escape the reality of our trade-dependent economy. Let me share my daily market take on what we're seeing today. These mixed signals perfectly capture the complex reality of Singapore's position in the global economy. While our service sectors like aviation continue showing resilience and recovery, our export-dependent economy is feeling pressure from global trade uncertainties. The Singapore Airlines story is particularly encouraging because it demonstrates how Singapore companies can adapt and thrive in their core competencies. The airline's ability to maintain strong load factors while expanding capacity shows operational excellence that should serve shareholders well over the long term. Their cargo strength provides additional diversification benefits that many investors overlook. The Q&M dental consolidation move shows another positive trend. Local companies are taking strategic steps to strengthen their market positions. In a competitive healthcare market, having greater control over subsidiaries allows for better coordination and potentially improved margins. But those export numbers serve as a reality check. They remind us why portfolio diversification matters so much. Singapore's economy is deeply interconnected with global trade flows, and when those flows get disrupted, we feel it immediately. This is exactly why having exposure to both domestic-focused companies like Q&M Dental and internationally exposed champions like Singapore Airlines creates better balance. For retail investors, today's mixed signals underscore the importance of looking beyond short-term volatility. Companies with strong operational fundamentals and clear strategic direction tend to weather these storms better than those riding purely on market momentum. The key is identifying businesses that can maintain their competitive advantages regardless of broader economic headwinds. That's the scoop for the SGX today, June 17th, 2025. Navigating these daily market shifts is crucial for your wealth growth in Singapore. If you found this digest helpful and want to get my real-time analysis, urgent insights, and a daily heads up on crucial market movements delivered to you up to a week before anyone else sees them, then our premium membership is for you. It's just $1 a month, less than a cup of coffee. Think of it as your daily dose of market foresight directly from my desk. Ready to stay ahead in the Singapore market? Just click the link in the description below to become a member. For your next watch, I'd recommend checking out my deep dive analysis on Singapore Airlines investment potential, where I break down the airline's long-term growth strategy and what it means for your portfolio.